A popular strategy for gaining financial independence is investing in dividend-yielding instruments. There are a couple of schools of thought on which is better, however, individual dividend stocks or dividend-yielding ETFs or index funds. Stick around because we're going to talk about which one is better for you. Coming up next on BTB Fusion. What's up, you guys? You're watching BTB Fusion, and I'm your host, Derek West. If this is your first time here, we're glad to have you, and we think you'll like it. If you're joining us again, welcome back. You know how we do it here. Let's dive right into the content, shall we? In any case, for any discipline in life, it always starts with the fundamentals. Even if you're a seasoned ETF or dividend stock investor, refreshing your mind on what exactly it is you're doing can't hurt. With that in mind, here's a quick refresher on ETFs before you invest. So the term ETF is an acronym that stands for Exchange Traded Funds. They can be simply described as a hybrid of stocks and mutual funds. ETFs trade intraday like stocks. Mutual funds trade at the end of the day when the net asset value, or NAV, of the underlying holdings can be determined. Like mutual funds, shareholders of ETFs do not directly own the underlying asset of the fund. They own shares of the fund itself, which then buys shares of the underlying assets. Like index funds, ETFs are passively managed and track a benchmark index. This means ETFs have low turnover compared to actively managed mutual funds. ETFs typically have lower expense ratios compared to even the lowest priced index mutual funds. ETFs have no minimum initial investment amount, whereas mutual funds typically require an initial investment of $1,000 or more. So basically, ETFs work like index mutual funds, but they often have lower expenses, which can potentially increase long-term returns. Plus, they're just easy to buy. I'm sure you know what a dividend-yielding stock is. If not, for the uninitiated, a dividend-yielding stock is a stock that you purchase just like any other stock. But in addition to growing your net worth by increasing in value, it comes with the added benefit of paying you back in various increments, as long as you hold the stock and the company that issues the stock can afford to pay you. What is less commonly known is that ETFs can pay dividends as well. Now, for a more in-depth look at what ETFs actually are and other stock and other investment instruments, take a look at a couple of the videos that I did on this topic. One's going to be linked in the little bar above, and a couple other are going to be in the description. Now, that said, although exchange-traded funds, or ETFs, are primarily associated with index tracking and growth investing, there are many that offer income by owning dividend-paying stocks. When they do, they collect the regular dividend payments and then distribute them to the ETF shareholders. These dividends can be distributed in two ways, both at the discretion of the fund's management: cash paid to the investor or reinvestments into the ETF's underlying investments. Similar to an individual company stock, an ETF sets an ex-dividend date, a record date, and a payment date. Without going into all the nitty-gritty, these dates determine who receives the dividend and when the dividend gets paid. The timing of these dividend payments are on a different schedule than those of the underlying stocks and vary depending on the ETF. For example, the ex-dividend date for the popular SPDR, or SPDR, S&P 500 ETF, SPY on the open market, is the third Friday of the final month of a fiscal quarter. In other words, March, June, September, and December. If that day happens to not be a business day, then the ex-dividend date falls on the prior business day. The record date comes 2 days prior to the ex-dividend date. At the end of each quarter, the SPDR S&P 500 ETF distributes the dividend. Each ETF sets the timing for its dividend dates. These dates are listed in the fund's prospectus, which is publicly available to all investors, as you might expect. Just as like any company's shares, the price of an ETF often rises before the ex-dividend date, reflecting a flurry of buying activity, and it typically falls a little bit afterwards, as investors who own the fund before the ex-dividend date receive the dividend and those buying it afterwards do not. So just a quick note for those of you new to buying and selling stocks and so forth. This is a minor pattern that both individual stock investors as well as ETF investors use to make a little quick cash in the market, i.e. you track the ex-dividend date and you time your buy just before that date to capture both the value plus the dividend payout. Some more notes on common ETF dividend payout patterns. The SPDR S&P 500 ETF pays out dividends in cash. According to the fund's prospectus, the SPDR 500 ETF puts all dividends it receives from its underlying stock holdings into a non-interest-bearing account until it comes time to make a payout. At the end of the fiscal quarter, when the dividends are due to be paid, the SPDR S&P 500 ETF, now that's a mouthful, dude, pulls the dividend from the non-interest-bearing account and distributes them proportionally to investors. Some other ETFs may temporarily reinvest the dividends from the underlying stocks into the holdings of the fund until it comes time to make a cash dividend payment. Naturally, this creates a small amount of leverage in the fund, which can slightly improve its performance during bull markets and slightly harm its performance during bear markets. ETF managers also may have the option of reinvesting their investors' dividends into the ETF rather than distributing them as cash. The payments to the shareholders can also be accomplished through reinvestment in the ETF's underlying indexes on their behalf. Essentially, it comes out the same. If an ETF shareholder receives a 2% dividend reinvestment from an ETF, he may turn and sell those shares if he'd rather have the cash. Sometimes these reinvestments can be seen as a benefit, as it does not cost the investor a trade fee to purchase the additional shares through the dividend reinvestment. However, each shareholder's annual dividends are taxable in the year that they are received, even if they are received via dividend reinvestment. So taxes on dividends and ETFs are often viewed as a favorable alternative to mutual funds in terms of their ability to control the amount and timing of income tax to the investor. However, this is primarily due to how and when the taxable capital gains are captured in ETFs. It's important to understand that owning dividend-producing ETFs does not defer the income tax created by the dividends paid by an ETF during a tax year. The dividends that an ETF pays are taxable to the investor in essentially the same way as the dividends paid in a mutual fund are. This is exciting stuff. This is really exciting stuff, wouldn't you agree? But I'm sure by now you're asking yourself, you're just dying to know, what are the pros and cons of investing in dividend-yielding ETFs? Well, they're similar to owning ETFs in general. One of the key ones is diversification. A dividend ETF is more diversified than an individual stock. Although ETF share prices can fluctuate just like stocks, your investment is based on the aggregated performance of the ETF and not just one stock. This can be good because you minimize the downside. On the flip side, though, you also minimize the upside. A stock can go to zero. This scenario is unlikely with a diversified ETF. And a stock can go up 2,500%, as in the case of Tesla. Hard to do that with an ETF. Another plus side would be smaller fees. Minimizing fees is key to building a quality portfolio without breaking the bank. There are many brokers nowadays that offer low to no fees on ETF trades. Some links in the description. Time. Another key benefit of investing in ETFs for dividend returns. Time. If your day job is not investing in stocks, or you're not independently wealthy, or you simply like to do other things with your time, holding index-yielding ETFs is just easier and much less of a headache than searching out great blue-chip stocks with a history of increasing their dividend yields over time. Just simply buy an ETF that does that and voila. Enough said. But it can't all be sweetness and light, can it? Well, obviously not. With the good comes the bad. So with the good comes the bad. What are the downsides to owning ETFs if you're looking for dividends for your investment purposes? Possibly higher expenses. Compared to traditional mutual funds, you know what I mean, mutual funds that track indexes, i.e. index funds, ETFs generally have lower management fees. However, if you compare that to owning individual stocks, and you manage your own portfolio of dividend stocks, there are no management fees. Obviously, this doesn't apply if you pay someone else to manage your portfolio of index-yielding stocks. That said, another downside is income volatility. As an income investor, your primary goal is to create an ever-increasing income stream from your portfolio. To do this, you should look for stocks with a long track record of increasing their dividends and the ability to sustain dividend increases in the future. Indexed ETFs are forced to buy the bad stocks along with the good stocks. This will increase the volatility of the fund's dividend payments, as underlying companies that are poor performers are forced to cut or eliminate their dividends. Now, this is also the thrust of the argument that Michael Burry makes when he tries to explain why he feels ETFs and index funds are going to be the cause of the next big market crash. Check out a video I made about the topic somewhere above in this area. So performance. Not surprisingly, individually selected dividend growth stocks stand a very good chance of outperforming an indexed ETF over the long term. Again, since indexed ETFs are forced to buy the bad stocks along with the good stocks. Often, the yield and the performance suffers. And this is generally true for buying individual stocks versus ETFs, and index funds as well. If you find a true winner, then as long as it is winning, chances are it's going to outperform a basket of winners and losers. Let's consider our favorite ETF again, the SPDR S&P 500 Dividend ETF. The fund holds all the stocks in the S&P 1500 that have raised their dividends every year for the past 20 years. A very small group of less than 100 out of 1,500 names qualify to be included. If we take a look at this ETF and its performance versus individual stock ETFs, you'll start to see a pattern. As an example, if we compare the current yield of the SPDR S&P 500 dividend ETF versus that of, let's say, the Coca-Cola Company, Johnson & Johnson, Walmart Stores Incorporated, McDonald's Corporation, then you'll notice that each of those individual stocks outperforms the index or the ETF that it's associated to. That said, the reality is it's up to you to pick a strategy that works for you. If you prefer the safety and time savings of owning ETFs for your income investing strategy, then well, you should own ETFs. If you truly want to maximize your income potential and you don't mind sacrificing time, then individual stocks that yield ETFs are just better in the long run. So click the video on the screen if you want to see more about the various types of investment instruments available to you, the tech-savvy investor. Also, be sure to click the like button if this video brought you any value to help spread the word to others interested in growing their personal finances and businesses through the power of technology. And be sure to click that notification bell, as we have more great videos coming up and we drop new videos every week. I want you guys to take it easy, and we'll catch you next time.